Well, thank you very much. So this panel really follows on the conversation that we've been having at this festival, which is one of the key themes has been around this notion of responsible tokenization, asset tokenization. We see that covered across various roundtables, panels, and we're going to continue the conversation today. This morning, MAS's Managing Director, Ravi Menon, spoke about, I guess, 3 areas around digital assets, digital money, and one other piece, which is around this topic of digital infrastructure. MAS has been looking at this space for a number of years, but I guess one of the areas that we've been really looking at and considering is how do we take that from concept to commercialization to scale. And one of the areas that we've been spending a bit more time understanding is the state of existing digital infrastructure, and we have launched and looked at, I guess, various initiatives just on this topic alone. One of these initiatives is the Global Layer 1, the GL1 initiative, which we announced yesterday, that seeks to understand the possible future state of an open digital financial infrastructure. Alongside that, another area that we've been looking at is the concept of perhaps interlinking networks. Networks that perhaps traditionally have been private and permission closed networks. How do we get some of these networks to interlink and interact with each other? At the same time, how do we access or extend that to existing settlement or financial market infrastructure? With this as the context, I'm going to start off the panel and really go around, and perhaps I'll start off with actually Carolyn. Before we speak about potential solutions, or in fact the roadmap to achieve that, help us to unpack this a little better. From your perspective, just sticking on the point about asset tokenization, from your perspective, has the case been made for asset tokenization? And from a BNY Mellon perspective, what are the kind of specific areas of focus that you think would make sense just on this topic alone? So, Carolyn.
Sure. So I think the case has been well made, arguably made many years ago. I think just being here this week, the conviction that continues to be around tokenization, you can see it in a lot of panels, you can see it in a lot of discussions. For Bank New York Mellon, the conviction comes from our position in the ecosystem. We actually touch 20% of the world's investable assets in Bank New York, so we're very fortunate to have a very diverse perspective across the different financial assets and the different financial services required across our diverse client base as well. We have $46 trillion of assets under custody at any given time. And I think that gives us a very unique perspective to see the challenges that do exist in financial market infrastructure and the financial market ecosystem. I think there's an increasing lack of tolerance to continue to enable some of those inefficiencies and that the risk that exists in the ecosystem. I think people are getting a much more sense of urgency around how do we actually leverage one of the key tools, which is tokenization. It's not the panacea of everything, but I do think it is definitely a tool for good in this space. And you're seeing a lot of convictions start to move from the do we see the benefits to the how do we get it done. I think as a collective team here, we discuss a lot of the challenges very often, and we're seeing a lot more resiliency going into the energy around how do you break down those hurdles. So I think the case has been made, but the case on the how to have adoption, that's where a lot of the focus is now.
So maybe extending this further along the value chain and just focusing on that, if we can maybe invite Watanabe-san, just your perspective, specifically on the value chain. I mean, you speak about asset, but I think it's useful to perhaps consider this in respect to the value chain in which they operate. So perhaps we can get your perspective on that.
Oh, yes. So first, working on this open platform infrastructure, can become, I believe, a foundation of a solution for all this tokenization business. And when I say it would become a foundation of solution, we have to understand that the platform itself is not a solution, but we have to work things around it to make it alive and work. Yes, so we have to develop technology around it, design rules, use cases, and governance as well. And on the way, the process of creating the whole value chain is, I would say, already a very valuable thing to work on. Yes. And also the fact that we are starting to globally collaborate among the public sectors, regulators and central banks and global commercial banks, which are composed of the banks you see, that has already been working on this for a while, will make it so more valuable. So I think this attempt itself is very valuable, and it's going to become something of a valuable value chain. Yes. And because by doing so, I believe that we can, globally plot out the essentials of the requirements we need to find out and solve, working against this topic in the industry. Yes. So to sum up, I say, if we want to incorporate tokenization into the global banking industry, I strongly believe that this approach is one good way to approach it. And let me go further and get into a bit about how MUFG is approaching this. And we obviously are looking for opportunities to provide value to our customer bases using tokenization and blockchain technology. Yes, and I think one way of approaching this is starting from something like tokenized deposits. Yes, because it has a harmonization with a current regulatory framework, as well as providing possibilities of linking with CBDCs for improving settlement process and settlement risks as well. And it can also function to provide trust anchors to other digital assets. And when that happens, we have CBDCs, tokenized deposits, stable coins, and then we have the private tokens and the cryptos. And the creditability will be complemented in that order. So I hope we can get there.
Okay, thank you very much. So Carolyn spoke about, I guess, tokenized assets and the broad aspects and areas in which BNY Mellon is focusing on. Watanabe-san, you just highlighted, perhaps to consider not just assets, but also the digital money and the different variations of that. We're going to change gear a bit. We spent a bit of time just as a teaser, just speaking about assets. I'm going to move on to challenges. So I'm going to pose the question actually to Uma, because we've heard so much about all the great things that JPM has been working on, the kind of the benefits and the potential of this space. I'm going to ask him the question about, you've been working on this for so long, you're one of the first institutions looking at this space. Surely it's not a bed of roses. What's wrong with existing infrastructure? Have we gotten to scale? Why are we even here? Is it all smooth sailing? Please, I'd like to hear your perspective.
So first of all, Alan, thank you for having us here. It's very nice to be back at the SFF, and I think the JP Morgan team, the Onyx team within JP Morgan has been here for many, many years actually, from the very first phase of Ubin, so it's almost like coming back home every year. From our point of view, we have built our entire infrastructure on a permission chain. It's a fork of Ethereum. We built it, and then we built all the infrastructure on top of it, and we've achieved significant scale. So, we are transacting on average $1 billion, sometimes several billion a day. Again, in the context of a large bank, may not be a lot, but in the context of this technology, that's a significant amount of volume, both in terms of money movement, but also in terms of trading, whether that's repo trades or collateral posting, etc. So, from our point of view, when we look at our infrastructure, we've created a walled garden. The walled garden is, JP Morgan and Friends. And that's a pretty big walled garden. So I can tell you it's actually quite hard to find a Fortune 500 company that's not a family or friend circle of JP Morgan. So, from our point of view, we can expand, we can scale, and our infrastructure is performing at scale. The issue a little bit is that that's still not enough. And what will inevitably happen, and what should inevitably happen, is that there should be multiple players in any ecosystem. That's true of payments. So, for instance, everyone here from, at least on the commercial banking side, UBS, MUFG, Boni, JP Morgan, we all send money to each other every day. And lots of money to each other for lots of trades and securities and things like that. Similarly, when it comes to security services, our businesses interact. When it comes to trading, our businesses interact. So the world is an interactive place, and by definition, no one institution can serve everyone, and frankly, should not serve everyone. So we need, even if we create at-scale platforms like we have, we need those platforms to talk to each other. And it's just challenging because not only is there a lack of standard technology, so we are doing something that grew out of Ethereum. Our platform was called Quorum, now Consensus Quorum, since Consensus owns it. Others people have built on Besu, which is very similar. But then you could actually start building on offshoots of Avalanche or others, and suddenly you have this sort of Cambrian explosion of platforms. So even if you think we are very large institutions, the connectivity between those platforms grows exponentially. So as everyone knows, if there's n participants and every participant has to talk to every other participant on a one-to-one basis, you're talking about n squared connections now. And so suddenly that problem gets out of hand. So I think that's one big issue that we need to resolve, because we need to be able to talk to each other's platforms in a manner that's safe, secure, and performant. So I think that's one. The other thing which we've also tried, actually we did it at Project Guardian last year, in the first phase of Project Guardian, was you could try to move to a lot of people would say, why don't you just move to a public blockchain? So yes, we could move to a public blockchain, and all of us could decide that we want to go to public blockchain. One, you have the same problem, which is actually there's way too many public blockchains in the world, and a lot of them are very different, and then they have complexities like tokenomics, etc. But even leaving that aside, the other issue is, let's say we have to send $100 million or $1 billion to any of the other commercial banks on the panel. JP Morgan is trying to do a transaction. Are we really going to send $1 billion to Boni or MUFG or UBS on a platform where if something goes wrong, you cannot hold anyone accountable? It's just very hard to see that happening at scale. So I think that's the problem. We need something where all of us can coexist with our own platforms and talk to each other. And that cannot be solved via one-to-one bridges. So we need something different.
So with that as a kind of a teaser, I'm going to turn to actually Christoph, right? So Umar has been speaking about his experience with private and permission chains, closed ecosystem. Perhaps on the UBS side, you have slightly different experience. You have been one of the earliest adopters, kind of looking at this topic of public permissionless networks with some controls built in. If you could share perhaps your perspective on this.
Yeah, with pleasure, and hi everybody. I mean, you say we have a slightly different experience. Maybe to point out right from the start, right? We have been involved with the public blockchain initiatives, but we're also very much involved with the private network initiatives. So we don't have a preference for one or the other. And I think it's so early days at the moment within this whole kind of digital asset journey that it would be actually wrong to kind of make a decision on that infrastructure. And I think it's very use case dependent. I mean, one of the reasons why we started working on the public blockchain space is because it actually allows you to innovate in quite quick iterations, and it resolves, at least at small scale, some of the issues that Umar just raised, right? The other thing to bear in mind is that the Swiss kind of regulatory framework allows us to engage with this. And maybe to give you a couple of examples, right, through our UBS Tokenize service or framework, we actually issued structured notes where we are actually able to connect the issuer and the investor directly, and there's sort of nobody in between. The other thing you may have seen, and this was part of Project Guardian, we announced that yesterday, together with our partners DBS and SBI Digital Assets, we actually issued a bond, traded it, collateralized it with cash on chain, and the whole redemption process was also on chain. So this is on public blockchains. And it shows that it can be done. The point that Umar raised around kind of connecting organizations globally, obviously that common infrastructure layer that these public blockchains provides is an ideal way of doing that. You actually don't have to integrate the systems at all. And the other interesting thing was you can actually watch the transactions happen online, kind of, if you just need to connect basically to the smart contracts, and then you can see them happen online. So from an innovation perspective, they're absolutely, they're actually fascinating. I guess the issue again is scale, right? At the moment, this is very small. And to get this up to a large commercial scale is another matter, and there's going to have to be a lot of work done in that space. I think what is fascinating is that the public blockchain space, that's certainly my perception, is evolving super fast, right? And I think we need to factor that into anything that we do. We're starting to see that possibility to have private enclaves on public blockchains, which on paper or in theory allow you then to have the best of both worlds, right? But again, I think it's early days. And before that scales, I think there's a bit of water that's going to run under the bridge.
Well, now we have gone round, heard from the commercial banks. I'm going to turn to Tommaso now. He's sitting in the middle of the room for a reason, right? So let's hear from the official sector. So the IMF has been at the forefront, bringing together different jurisdictions, representative, speaking about this. You yourself, you have led some of the thinking around this space, around multi-currency, cross-border platforms. Maybe just hear from you, your perspective on the challenges that exist.
Thanks very much. So this is the perspective of the man with the tie. I do this so I can recognize other people from the official sector around this incredible event. We look at each other and we wink when we see another tie. So the views of the IMF here are very much focused on trying to avoid more fragmentation. There's a lot of experimentation that is going on, and you've heard about some of the examples here, and that's great. But we want to make sure that eventually we do not increase the fragmentation that already exists in today's world. We worry about fragmentation from the standpoint of simply connectivity, flow of funds. We want to make sure that capital can flow to where it can be best put to use globally. We want to make sure that small enterprises can grow beyond borders. We want to make sure that households can get remittance payments at low costs anywhere in the world. We also are worried about fragmentation from the standpoint of creating a digital divide between the countries that are advanced in technology and the countries that are not, between the countries that can regulate technology and the countries that cannot. We would like to see a world much like this room, where the people in the audience are just as comfortable as the people on stage in very nice sofas. This is the first panel where I see this. But that is the problem that we're trying to solve, the digital divide problem. We're also worried about fragmentation in governance arrangements, in regulation. There are global standards that we would like to see adopted across the various payment systems that are put into place. One solution to fragmentation is, of course, for everybody to be on the same network, using the same infrastructure, but that often can be provided by one or a few players, and then we worry about competition, which is also an important public policy objective. We worry also about policy effectiveness. So it's great to see money being able to flow more efficiently between countries. But of course, this raises the possibility of much higher degrees of currency substitution. That is, using a foreign currency in your domestic jurisdiction, and thus undermining the effectiveness of monetary policy. In terms of capital flows, many countries around the world, not here in Singapore so much, but many countries around the world rely on capital flow management measures. And it's important that somehow those policies can still be implemented in the digital world where money can flow more efficiently between countries. So those are the challenges that we see. While we applaud the type of experimentation, responsible experimentation that we see around the world, we worry about fragmentation, competition, and the effectiveness of policies. And so we'd like to have a solution that ticks all those boxes. And I think we'll speak about solutions later on. Thanks very much.
So with that as a transition, maybe we'll hear from Christoph, and then I'll probably ask Uma the same questions. So we heard the problems. I asked you the problems. I'm going to ask you what are the solutions then. So Christoph, maybe you start first.
Yeah, look, the solutions were already alluded to by my fellow panelists here in many ways, what we need is a sort of common infrastructure layer which is open, upon which you can innovate, and one key element here, it has to be regulated, right? So that's the big picture, that's the vision, that's what we need. One important point around that is, to me always, and that's the way I think about it, is you need an incentive to switch from the old to the new. Because actually, you know, the current financial system, even if in the background the nuts and bolts are not perfect, actually it works really quite well. So that solution has to then add value ultimately to clients, right? That's actually the only thing that counts. Now, the question is how you get there. And that's a big question. There's one thing, which is you have these private networks which exist today, and some of them are quite impressive. The question is, how do you connect them to get the ecosystem effect? So it's these bridges. It's complex to build bridges. It adds vulnerabilities, but it's one possibility, right? The second one is you bring or you build an entirely new infrastructure layer that banks across the globe can connect to. Of course, that's a really heavy lift, right? Because it needs global alignment on regulations, on standards, standards being regulatory standards, but also product standards. So that's a heavy lift. And then the third one is the one that was also mentioned a few times, including by myself, is these public blockchain networks. But we know that these public blockchain networks, certainly in today's state, have quite a few challenges to scale at the scale that the current financial system needs them at. And I think the reality is, you know, we are at the beginning of a journey. And there's, in my opinion, not going to be a silver bullet with this. In the end game, you're probably going to have a mix or a mosaic of all three, probably large ones in each category that need to be connected by bridges. But again, nobody can say that today, right? I think that's important. So I think we need to approach this with an open mind and keep optionality open, right? Because in the end, what we need is to produce the best solution for the client.
So maybe turning to Uma, do you have anything else to add on? Any perspective? We've been discussing, I guess, on the GL1 initiative. Anything you would like to add on that?
So I think, I mean, I would generally agree with the three options as they exist. I also, you know, feel that option 3 at this point is just not fit for purpose, the public blockchain construct for regulated, large value institutional transfers. So again, maybe we'll get there one day, but for now, that's a bit far away. I'm also a little bit more negative on bridges because I feel like bridges are where all issues usually happen. So if you think about where cyber attacks happen, where issues of liquidity getting stuck, or frankly, assets deployed in weird ways when they're locked up here, but then, you know, they end up getting leveraged somewhere else. We saw this actually last year when the crypto ecosystem unfolded a couple of times. You know, you basically just couldn't keep track of what was going on where, and suddenly you had these weird exposures pop up. So I mean, again, as crazy as it sounds and as heavy a lift as it is, and I fully agree with Chris's point on that, but ultimately, I am a fan of the global layer 1 solution, and, you know, to basically for the Lord of the Rings fans, I mean, it's like one layer to rule them all is the approach here. So, you know, I mean, we want one thing which can ground everything else. And it will be a heavy lift not only to build, but to design the specs, to figure out where the funding comes from, how this thing operates. But we have models. We have models of everything from, you know, what I would call not-for-profit or not revenue-seeking entities like Swift, which support everyone, all the way to revenue-seeking and very profitable entities like Visa, MasterCard, et cetera. All these are worldwide infrastructures. There's not one model. There's multiple models that exist. As for re-platforming, I also agree. I think that's going to be a heavy lift. But in some ways, it's easier to re-platform earlier in your life than if we go on another 10 years. It's going to be almost impossible. And you know, I mean, just to share a fun anecdote. I mean, there's satellite dishes in the U.S. like which hunt for alien life and stuff. And the code on those things was written so long ago that they used to have tapes, not hard drives. And when they swapped out the tapes for the hard drives, they never changed the code. So the code, they wrote a middleware where it actually pretends as if there's a tape underneath and it's a solid state hard drive. So who knows, maybe we'll use some approach like that. But ultimately, we will have to re-platform to something. It just, the situation we have is going to be great for JP Morgan or some of the big banks. It's just not sustainable at a global level.
Before we move on, maybe you just unpack that, because you mentioned that one ring to rule them all.
Yeah.
And the concern has always been, if we have JP Morgan in the room, JP Morgan will be that ruler of that one ring. How do you address that?
First of all, I think that's a very bad notion because we are very humble people at JP Morgan, as everyone knows, so we would not want to do that in the first place. But actually, jokes aside, from our point of view, it has to be structured as a utility that has objective measures for people to come in and does not actually enrich anyone. So, obviously, again, there's various models, but let's think about something like Swift. I know Swift is out here. They're big partners, and they, by the way, make the world work from a financial point of view, both in markets and in financial services, money movement. But if you think about Swift, there are folks, actually, I think most of the folks here on the stage have, and the commercial banks, all of us have, stake in Swift. We have governance rights in Swift. But at the end of the day, it's not like we make money from Swift. We pay Swift, and it's a utility, it's commonly owned. So I think you have to have a utility model that is with very distributed ownership and with some oversight from people with ties, so it can get done. So, as Tommaso said, the official people, like the ones who show up in ties. Although I don't know why Alan's not wearing one, so there's that. So
I got to fit in with the rest.
Yeah.
So maybe turning over to Carolyn, just to hear your perspective, just reacting maybe to what Uma has mentioned. What's your expectation of this?
And as a former JP Morgan person, I can account for what you've just said. But what I would say is, Umar said it in the beginning, there's such an interdependency across all of the banks. We rely on each other in ways that, you can't actually create the fragmentation. But if you think about a global layer one, it's at that base level where we don't actually compete with each other, right? And I think that's a really, really important thing. That's why it needs to be open. It needs to be accessible to even more than banks, frankly, at some point, right? But obviously starting with the bank layer first. Then we can start to compete at the app layer to differentiate ourselves even more. And I think that's where it's really, really important. It's not at the sacrifice of competition, but it is making sure that we're actually not competing at the area that actually creates the inefficiency. And if you go back to how market infrastructure started in the beginning, back in the 1960s, you had all these problems with volumes. You introduced the CCPs, the CSDs that come in the 70s, and you've got these central counterparties that kept the infrastructure safe. Very important, they serve a great role. Now we have situations where, to Umar's point, that linking and exchange, like the pun of the actual chaining that happens across the value chain, that creates a lot of friction and a lot of risk. Now we have the opportunity to actually share ledgers together. Again, I don't think one ledger will rule them all. I think there will be ledgers for different use cases, different purposes. There'll be a need to have interoperability across the ledgers. But I do think it's very important to start to take out that risk when you're doing all of these hops between the various parties that will always be dependent on each other.
So if I understand you correctly, it's perhaps one way of thinking about this as a foundational layer, a layer one, and upon which different layers could be built up for specific use cases, specific networks.
Exactly, and that's where the value will be created for clients, at the layers that are above that ground layer. And that's what's really important. Think Swift, right? It's the same thing. It's a messaging layer. We're not competing on how great we message. We're competing on the things that the messages enable.
We're going to turn over to the person in the tie, in the official sector. Maybe just on this point about keeping things open and a possible path forward as far as the solution is concerned. Any thoughts, especially from a policy perspective?
Yeah, thanks very much. So at the IMF, we're not going to build anything. We're not piloting anything. But we are thinking about potential models of interoperability because it has macro-financial implications. And one of the models we've been thinking about and writing about sounds a lot like your basic layer one architecture. And essentially, the vision is of a basic layer, a network layer, that allows for settlement, not just messaging, but actually allows for settlement of, to start with, central bank money in different currencies. And that would be, at least at the basis, a possibility to facilitate interoperability. But then, of course, we think that it's not just about moving value, but also managing risks around that movement of value, potentially introducing swap contracts, potentially introducing basic auction mechanisms, because in many countries currencies are not especially liquid, and we know from experience at the IMF that setting up auctions can help. So how do we do that? The very simple idea is to have basic templates, basic smart contracts that participants can tailor, customize in order to access those very basic financial contracts. That would, of course, facilitate efficiency on the platform, because a contract that allows me to be paid tomorrow, a contract to receive money tomorrow, can be pledged today as collateral for a swap contract. And because there's a single information set, there's a single basic network, that is possible. Then we can think about an information management layer on top, which is very important for compliance purposes. But it's important to take a step back and to understand that what is essential is a governance arrangement, a clear governance arrangement around all of these layers. And by governance, I don't just mean ensuring that there are risk management mechanisms of this platform, but also harder issues like which countries can participate and what are the criteria to participate. How can you deal with capital flow management measures, as I was saying earlier? How can you ensure that participating countries can implement certain basic policies on this platform? We need to agree on those governance arrangements, and without that, we find it difficult to imagine that such a platform would be compliant, would be supported by countries worldwide. The real question is, of course, what is the role of the public sector? We can think of a very minimal role of just setting the specs, the requirements for this type of infrastructure, all the way to building part of this infrastructure. Again, it wouldn't be the IMF, it would be a group of countries perhaps that decides to do this, to operating the infrastructure, or maybe not. Maybe that is the role of the private sector. Those are questions that we need to answer, that we need to tackle and answer relatively quickly. Of course, the public sector would be involved in supervising and establishing governance arrangements around this. And then, of course, there's the question of, going back to the technicalities, the models of interoperability. Do you put central bank money directly on this platform? Or do you escrow central bank money and trade digital representations of this on the platform, basically liabilities of the platform itself? And those questions are important. They seem technical, but they're actually quite important. Central banks will care about which institutions touch their liabilities, their reserves, and under what conditions. So I think those are that's the basic vision that we'd like to explore. I'm not saying that this is the way to go necessarily, but this is a vision that we should explore. We should determine the costs and benefits of this. We should determine the trade-offs of doing these, and we should establish what decisions we need to make in order to potentially make this happen in the future.
I'm going to spend a bit of time on technology, because we are getting questions from the audience. So one of the questions that came up was just on the infrastructure. So is there a view that this is actually a very high-risk systemic infrastructure? One of the questions was that it's comparable to perhaps really highly secured infrastructure. So what should we do as we are building this out from a cybersecurity perspective? I don't know whether any of you would want to jump in from that lens, just to consider, other than the policy and maybe the business objective from a technology lens, what else should we be considering, given that it's perhaps systemic?
Maybe I'll start and others can jump in. At the end of the day, it's definitely going to be systemic infrastructure if it's built. Definitely going to be a very important infrastructure, but then all of us have experience working with and building PFMIs, so payments, financial market infrastructure, but also general market infrastructure. So I don't think you have to do something super duper special, but we have to make sure that it complies with all the requirements that any global FMI would have to comply to. And from a cyber point of view, because there's a high reliance on cryptography in these platforms, we just have to probably make some, choices around how you deploy, what type of cryptography gets deployed, et cetera. I mean, there's obviously the sort of quote unquote quantum threat that depends upon who you ask, could be 2 years away or 20 years away. So, just making sure that you view that. But I don't think it shouldn't be an impediment, because it's not like we haven't done this stuff before. All of us have, so.
Yeah, and look, that foundation of trust is the core of everything that we need to do. I think the interesting thing that we need to design for is the interdependency that we talk about between payments and assets and securities. Because this could actually present the first opportunity to have securities and cash live in the same platform. Today, they're on completely different technology rails, different operating rails. They operate like they're complete distant second cousins that have interdependency. But if you think about a global layer one as an example, designing that dependency and designing for making sure that there isn't over-dependency or complications in there, which then obviously making sure that it is resilient, it's got the trust factors in there, that's going to be really, really important. But obviously the benefits outweigh the fact that keeping it separate creates that friction and a different type of risk that happens after the fact. So I think it's important as we design through it to make sure that we're thinking about those potential new-ish types of risks that we could introduce as we bring securities and cash together.
Christoph?
The way I think about kind of a common infrastructure layer, it has to be common, open, and in particular decentralized. And if it is decentralized, that actually, I mean, we know this, that's one of the purposes, is to reduce kind of the points of attack. I mean, it's very general, right, as an answer, but I think from a principles perspective, I think that's something to be borne in mind.
So before we speak about maybe the roadmap and looking ahead, the other questions that I'm getting is from a usage perspective. Is this global layer one or this infrastructure designed to be only used by banks? Is it going to be, the participation going to be broader than that? Any perspective on that question? Will consumers use it?
Never said
Okay, Watanabe-san, sorry.
My understanding is that it's basically for FIs to use this infrastructure because it's an infrastructure. But if we look at the evolution of digital technology, let's think about the blockchain 5 years ago. We didn't have like a digital wallet for individuals, but now we do have individuals accessing the blockchain through wallets. So that kind of technology evolvement can reach the individuals to the infrastructure as a possibility. But I think that's a very early stage now. So in the initial stage, I think FIs and central banks maybe access it, and then we come up with a foundation, safe and secure, and then maybe we can think about opting to the real more individual or retail layers.
I think just go back to the internet. It's very simple, right? You're not as a user sitting there in the bowels of the internet infrastructure. You're just using the internet and you know how to do it. So that user experience needs to sit again further up than the infrastructure layer. To Watanabe-san's point, we need to operate the infrastructure layer across the banks, but I do think it's probably banks plus at some point. But again, given where the banks have relevance, managing across that ecosystem and financial market infrastructure, I think starting with banks makes sense.
So maybe moving on to perhaps how do we operationalize this? How do we move ahead with this? So Watanabe-san, I think you've been thinking about this quite a bit. So what do you think are the key milestones that are needed to operationalize an infrastructure like this?
Yes. I think there's at least 3 core elements that we have to balance. One is business, number 2 is governance rules, and number 3 is technology. And if I go one by one about the business, we have to come up with a good use case that explicitly stabilizes the value proposition of what we are doing. So To be more precise, I think we can utilize like programmable payments and atomic settlements, DVPs, PVPs to improve settlement services, and we can start from there. We can start from domestic payments, settlements, and then go to regional, and then globally. We can go there gradually to stipulate the value proposition on business. That's, I think, very important. And the other thing that is important as well is the governance rules. Obviously, we need to align with the regulators, KYC, AML, CFTs, because not much digital asset is being handled in that manner. And also, the important thing about having this utilized in industry is avoiding liquidity silos. We need to put that in our target according to the governance rules. And number 3 is technology. And I think when we talk about technology, new technology, I mean, the most challenging and important part is integration. So we have to carefully design how it can migrate into the current banking business and the industrial structure to make the smooth transition, to make this happen. And other technical aspect is that we've been talking about networks, and there's a trend of public permissioned networks, something that maybe we can consider. I don't know, maybe Chris, you might have an objection, but we can talk later. So it has to be, we have to come up with a safe network solution, yes, which is still under consideration and debate. Thanks.
Anyone else want to add on that point? If not, maybe I'll just turn to Tommaso. I mean, what's your expectation from the official sector for such an initiative?
Thanks very much. If you allow me, I just wanted to add one thing to who would use this infrastructure. Please. Because of course I'm sitting on stage with big banks. And it's no surprise that they said it was the big banks that should access this infrastructure. And I understand the arguments very well. This is financial market infrastructure that needs to be very stable, accessed by companies that are very well regulated, etc. That's very important. But I do want to emphasize and come back to this idea of the digital divide that I spoke about in my introductory remarks, and the importance here of establishing infrastructure that works for all countries and that will facilitate payments, including small value payments that are so important for households around the world. And the ideal is that if we can build infrastructure that works for the big banks and for their business models, for their bottom line, to trade financial assets perhaps as well. But if we can leverage this same infrastructure to make the small value payments, the remittance payments also work between countries. And perhaps that means that central banks get more involved in offering foreign exchange liquidity on these platforms for some countries. Perhaps it means including non-bank financial institutions that are specialized in payments through the banks or through the central banks, I don't know. But ultimately, we do want to make sure that we build an infrastructure that does provide a more inclusive world. And I think there's the possibility to do this. As to next steps, I mean, I think that it's important to realize that we are very early in this voyage, and that we need to be a little patient. We need to, if anything, establish a common taxonomy to start with, and then from there consider the options that we have available in terms of architecture, the trade-offs that are involved in these types of options, the use cases, including the small value payments. And then I think it's important for the public sector to establish a list of desirable features and desirable governance arrangements to be satisfied, at least at a minimum. The banks may want to add features, they may want to add functionality, and that's fine, but the public sector should at least globally agree on some sort of desirable features and governance arrangements. And I think with that vision set, then it'll be easier to have these platforms built and operated. And we're very much in favor of fostering this debate, and because we represent so many countries globally, facilitating this discussion at the global level as well.
So we are getting challenged on that topic, right? Which is, we're speaking about open networks, but here we have banks, group of banks, hosting the network. How is that really an open network? Anyone wants to respond to that?
I mean, I think it depends upon It depends on what you mean by open. So there's open and then there's open. I mean, one open is, okay, it's open to anyone in the world, they can come in. But then how do you even decide who the person is? We all know there's KFC, I mean, KYC, there's AML, FTC, there's all kind of like terrorism funding, etc., that we have to check every transaction for. So a fully open network, while it sounds like nirvana, is hard to achieve. So how do you get there? I don't think we are saying that it can only be big banks, but there has to be some basic ground rules on who can be on the network, because if the network does not have a defined set of regulated participants, you can end up in the same chaos we started with, where we have transactions that maybe all of us have to validate because we own nodes, and those transactions end up being bad transactions for whatever reason. So I think that's why I think it's not saying it's closed to these big banks. I mean, it should at least be open to all banks, maybe all financial institutions that are regulated, and then we can decide how far you want to go beyond. But that's where the public sector can play a role in deciding what are the ground rules for letting people be on the network in a manner that does not degrade the network.
So Carolyn, there was some question around the layers in which you spoke about. The layer one being that commodity layer. So there's, I guess, interest in terms of what are the possible value-added services that can be built upon it. You mentioned KYC, AML as, I guess, one of those modules. What else do you think would be value-added service?
Yep. So you've got the compliance layers. You've got, if you think about an investment life cycle from issuance, so you've got investors and issuers, and Christoph talked about this, the need to bring those two parties closer together in terms of the services that they add. If you think about pure custody, if you think about payment services, if you think about collateral, if you think about trading, all of those different services live in what I call the top app layer, right? And the ability to intertwine those services for the needs that a client has, and different clients are going to have different needs at different times, right? That is where we can differentiate ourselves as banks. It's where different players in the market can differentiate ourselves. But if we're not able to build those apps on a foundation that we can trust, that we can ensure that the things that we're going to do, the movement of cash, the movement of assets, just said very simply, that if we can't trust that that's going to be done with certainty in the way that we expect it to be done, it's very, very difficult for us to be able to bring new and advanced and innovative services to our clients. So that's why we need that base layer to have that implicit trust factor in there. Umar talked about different types of participants. The key is regulated participants. Because again, it doesn't have to be the bank layer, but it has to be participants who can bring a certain standard to bear on that layer. And then again, we can start to differentiate further up that value chain.
So I think we are almost running out of time, but I think one of we're getting a lot of questions on just on terms of what to expect in terms of roadmap. When can people start to see this? What's next? Anyone wants to give clarity on that? Maybe I'll turn to the person next to me.
So I think to some extent it's in the collective hands, not only of the people on the stage, but many others like us to figure out what the next steps are. But this is a long-term project. I don't think this is something that happens overnight, especially if you want to build it with proper governance, with central banks like yourself and others across the world weighing in, IMF weighing in. You can imagine this will take some time. So I think the immediate next steps are to actually, as I think Tommaso had mentioned, like get the governance model clear, get the primary objectives more clear, and then go to work versus trying to get ahead of ourselves and build something without really thinking those things through. Otherwise, it'll be a great POC or pilot, but it won't scale. So.
That's exactly what I was going to say. This is not another POC. Yeah. I think everybody's exhausted with POCs. This is us putting our commitment, our capacity, and our firm's capacity behind doing something right, even if it takes that little bit longer to do it. And Alan, I know you wanted it done yesterday, so I'm glad you didn't answer the question.
No, so I think this is the start of a journey, perhaps a longer journey than we would expect. There are different elements, as we've discussed over here. I think where we are really is in the design phase. We're trying to explore, understand the design, what's needed, and it's a process. So I think hopefully this conversation has been enlightening in helping to demystify perhaps some of the myths that we have over here. The idea here is about building, I guess, an open digital financial infrastructure that's as much as possible accessible to the wider population, but also to operate in a way such that there are regulatory considerations, attributes built in to such an infrastructure is designed perhaps at the lowest level, at a commodity level, such that a greater part of the ecosystem can participate. So I think that's all we have at the moment. I think the road is ahead of us, and certainly welcome, open invitation for ideas, suggestions on how we contribute towards, perhaps, as Carolyn has mentioned, the future of the internet. So with that, I thank the panelists very much. Please put your hands together and thank my panelists here. And thank you all for the warm participation. Thank you.